Good morning. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers in Silicon Valley for the last 40 years. We're here today to talk about the Silicon Valley real estate market and week number 40 indicators. Real quick, the root URL is in green. That gets you to my YouTube archives of these presentation. You add the purple year and you get to this live presentation on Saturday morning at 9 a.m. You add the year, month, date, you get to the archive of that specific episode. You add the word handout, year, month, date, and you get the handout. And today's is posted as of about 15 minutes ago. So it's there for anybody that would like to see it. I have changed the order on the slides a little bit based on feedback. So please don't hesitate to reach out and let me know what you like and don't like and what changes you'd like. I'd be happy to incorporate them. Anyway, this is the first data slide. It's showing two major components: the supply and the demand. The reason there's three lines is there's two for supply. So the overall supply is this deep blue line down here, and that's sort of the level of the water in the reservoir. And you can see we're somewhere around 68% of the inventory you'd expect to have. The water coming into the reservoir, the new listings, is this gray line. And basically, when you look at it, the big spike ups are related to the holidays. Basically, you're right at the 100% mark, which is the 5-year median of 2015 through 19. So the number of new listings coming on the market is exactly where you'd expect it to be. There aren't more sellers coming on the market fleeing California, fleeing Silicon Valley. They're just exactly the number of new sellers you'd expect every single week. The reason for the decreased supply is the red line up here, the rust-colored line, and basically that's the demand. We're having more offers accepted every week, and if you sort of average that out, you're somewhere around 20% above the normal number of offers accepted. So if you're selling 20% more inventory and you're having this normal inventory come in the marketplace, that's why your level of the reservoir goes down with your inventory, and that's exactly what we've been experiencing. Now, this is the single key indicator, days of unsold inventory. That's the ratio between the supply and demand. So we're down here on this blue line, and we're very low. We're somewhere around 22 days of unsold inventory. That is just superheated. Yes, we were lower. We were down here or somewhere around 18 days earlier this year. Some of the component single family homes in Santa Clara County, I think, got down to 15 days. Basically, anything from 40 to 80 is a balanced marketplace. You have to get up above 80 to get into a buyer's marketplace. Silicon Valley is rarely in a balanced marketplace, which really doesn't make a lot of sense. That is where you'd expect the market to behave, but it's basically seems to be unstable there, and it quickly goes into either a buyer's marketplace or a seller's marketplace, spending far more time in a seller's marketplace than a buyer's marketplace. This is the overbidding for each week. So I look at the sale price to list price ratio of every single transaction reported on the MLS for the past week and then draw the line. So as the line goes up this way, the market's improving. Sellers are getting more sellers are getting more above their asking price. Basically, you have 22 weeks with 2 weeks. This is the best week out here, April of 2018. This is the worst week ever, December. And on the worst and best, I only have monthly data. I'm not going to go back and do 52 weeks for 20 years of data to get it to a weekly basis. So we have to settle for months. So best month and the worst month ever. And then the numbers in between are the weekly data. And the concept here is the solid lines, which are sort of towards the bottom side of this, are the most recent. The dashed lines, which are sort of in the middle and hard to see, are the second oldest lines. And the oldest lines are the dotted that tend to be on the top of the graph. So what that's basically saying is the market was better and it's gone downhill a little bit. But when you start looking at the bounce here, the blue line here is August 28th, I believe. And, that was the worst week we ever had this year in the last 22. And obviously it was worse earlier. And then up here, the brown line is August 21st, which is the best. So you can see that we've been, oscillating a little back and forth. And these are not huge changes, but it just gives you some idea. So that's a quick recap, and we'll get into this graph here later. I just want to show people what's coming up. This allows you to look at each micro market and then look at which are the components that are important: DUI, frequency of overbidding, magnitude of overbidding, and what the price range is, or potentially starting over here with the price range and then seeing what kind of market you're in. So I'm open for questions on the recap, and then I'll pause and go into details from there. Do I hear any questions? Not hearing any. Now we'll slow down the pace a little bit and talk about the details. This is looking at the number of new listings only coming in the market. And that's, again, the blue line compared to the yellow line. So you can see there's weekly fluctuations. You can see that they're fairly close together, which is why when I did a percentage, it was basically right where you'd expect. The purple line is the break between 2021, the current year, and last year, 2020. And in order to get the separation, I have to add in a week. So week 42 in 2020 is really week number 41. But you can see where the yellow line, the median, is well behaved and is going to connect onto that because it's the repeating of the data. The blue line is significantly different. We had more new listings last year than we are this year. And I think that's pretty straightforward explanation. We had the pandemic shutdown basically mid-March of 2020, and that caused those sellers not to come on the market. So they were coming on the market in 2020 later in the year, and that's why we had the surplus. We've gone through those sellers, and so I'd expect this line pretty much to follow the yellow line. Now, another observation I'll throw out there is holidays negatively impact real estate, which is partially the reason this declines so much. Holidays are having less of an impact during the COVID, so I would actually expect the future data to be between the yellow line, the median, and last year's blue line. So it doesn't give me a lot of range, but basically come down something like this and go down, but not as much as it normally would. Now you look at total inventory. So the yellow line again is the 5-year median. That's where you'd expect inventory to be. And you can see last year, and even at the beginning part of this year, when people were crying that there was a lack of inventory, we actually had a surplus. Then for a few weeks, we had normal inventory, but basically since week 16 of this year, we've had below normal inventory going forward. And I anticipate that continuing for at least a period of time, because you're going to have more extra listings coming on the market or drop in demand to build up the reservoir even to normal levels. Now we're looking at the number of new offers accepted. And again, this is for each week. So the yellow line, the gold standard, is the 5-year median. And you can see the blue line is above the 5-year median. It was above last year. It's been above this year. And if you actually look at the vertical separation, to me, it's growing, which means that the demand is increasing relative to the 5-year median. And obviously that can't go on forever, but that's what the current trend looks like to me. This is the days of unsold inventory. Again, that's the single biggest indicator or the single key indicator. And it's of the 3 major components, which is Santa Clara County single family homes, San Mateo County single family homes, and condos and townhouses in Santa Clara County. And you basically can see you had the holiday slowdown, which happens every year. You had the pandemic slowdown and the holiday slowdown of 2020. Basically, we've been on fire and basically at record low levels. So that explains why the fast market pace and why sellers are getting over their asking price. This now shows you graphically on a map the days of unsold inventory for single family homes in the different micro market areas. So it's color coded. The lighter the shade of the pink up here is going to be your lightest color, the slower the marketplace, and that's going to be Menlo Park, Atherton, Portola Valley at 54 days of unsold inventory. The redder the color, the faster the marketplace. And I would guess that looks like Cupertino at 16 days, and also the Bay Cities at 17 days. Foster City is hard to really pick up, but right up here, that's absolutely the quickest at 22 days. Campbell, Milpitas, North Valley, Berryessa is at 15 days. So and even Campbell's at 13, which is part of the reason why it looks like such a large area. That's getting pretty close to saturated, but I've blown out the saturation down to 7 days. So every one of these is going to be a little bit different color of shading. This is showing the frequency of overbidding over time for the macro data, which is Santa Clara, San Mateo County, single family condos and townhouses, all in a blender. And that product doesn't exist, but it gives you a quick read of what the market's doing. And you can see we're up here at somewhere close to 80% of the sellers are getting more than their asking price. We dip down, and remember, these, to get to overbid frequency and magnitude, I need the sale price. So I need to have closings. So these are offers that were actually negotiated like 6 and 7 weeks ago for the most part. But you can see that we did have a dip down for basically 2 weeks, but we're basically back up at 80%. Last year, when we thought we were hot at this time of the year, we were only at 65. And it gets harder to go up higher. In other words, it's going to get really hard to go from 80 to 85%, 85% to 90%. And micro market areas have hit 100%. In fact, I think it was Foster City was at 100% for about 4 weeks, I think it was. This is broken down by the three major components. So you can see San Mateo County single family homes has been a little bit more volatile. Santa Clara is the hottest of the three marketplaces, and it's been pretty flat. It's been pretty flat since April. Yes, there's some minor fluctuations, but nothing significant. The condos and townhouses tend to be more stable, and they've been basically stable since maybe mid-April, beginning of May timeframe. This is broken down single family homes only in the different micro market areas geographically. Same concept, the redder the color, the more frequent overbidding is. And you can see Cupertino Sunnyvale is at 92% essentially. Foster City's at 91%. That's basically the same. There's a lot in the low 80s. So you can see that we're having just a phenomenal amount of buyers saying, I want to buy this house. I'm going to offer the seller more money in the hopes that I get it. And a lot of times they don't get it. This is the magnitude of overbidding. How much are they overbidding? And this number here is coming in at about 107.5%. I did quickly look at it because I do every once in a while mention that this is everything in the blender. If you look at only those people that overpaid, only those transactions that overpaid, the amount of overbidding then jumps up to 110%. So it's not a huge jump up, but it's actually bigger than I was anticipating it being. But if you're a consumer trying to decide how much do I want to overbid, you can't just say I'm going to pay 7.5%, because if it's a property that's deserving of overbidding, that number actually goes up to 10%, and the range is pretty high. I think the highest overbid today this week was something like 51%. So someone paid the seller 1.5 times what they're asking. So you really have to do a market analysis, determine more importantly, what is the property worth to you? Because any one particular property might be more valuable to you than market value. This is the overbid mapping. And again, the concept's the same. The redder the color, the higher the overbidding, the paler the color, the less the overbidding. Los Altos, Palo Alto has been coming in fairly strong at 108%, but still blown away by Cupertino Sunnyvale at 114%, which matches Foster City and the San Mateo County, very north area, Daly City, and Coleman, in those areas. We already discussed this map a little bit. I bring that up because here we're now looking at 12 weeks and you can start seeing the separation. So you can see the purple line, that's the most recent line. Then the dark orange here is the second most recent. And then the gray, which is above the purple, is 2 weeks ago. And then the light orange, which is 3 weeks ago, is below again. And then you have the dashed lines, and there's some dashed lines below and some dashed lines above. Dotted lines are mostly above. You can basically pick up, it's hard to really tell, but it's these weeks, mid-August to end of July, that had the highest amount of overbidding overall. I think August 7th is the brown one down here, so that's the least. So it was probably more like the July timeframe where the prices were the highest. This is a little bit more colors added to try to make it a little clearer. It's showing the four major components, and basically I'm now putting the range of what I consider sort of be a balance. And I don't have a lot of experience with this inventory, so that would just be sort of my initial guess. And then so the red color indicates it's a hot marketplace. So for example, in Santa Clara County single family homes, if you only have 53% of the inventory, that is going to make it harder to buy a house. The market's going to be faster, buyers are going to be willing to overpay, and that's why it's red. Then when you're in San Mateo County condos and townhouses and you have 185%, that clearly is going to say, hey, there's plenty of inventory, buyers, you don't need to worry about it. And that's why it's blue. And DUI, you know that 40 to 80 is my normal range. So everything is in the red here. But if there was anything in that range, if it was within the range, it'd be black. And if it was above 80, then it would be blue. Then moving on to the sale price, we look at the frequency and magnitude of overbidding in the same kind of range. You can see my range for frequency overbidding is a third to half the sellers. getting more than their asking price is a balanced marketplace. That's probably only true in Silicon Valley. You go anywhere else in the country, and even if 25% of the sellers are getting more than their asking price, I think they have a strong marketplace. And the magnitude of overbidding is pretty narrow, and it's just nature of the beast. From 99 to 101.5%, I consider to be normal in a balanced marketplace, and you can see everything here is red. What's sticking out, in my opinion, really is why San Mateo County. Now, it is the slowest out of them, but when you're at 185%, why the DUI is still at below 40, and why the frequency of overbidding is at 80%. I mean, that's the highest frequency of overbidding, and yet it's got the slowest marketplace. So these are just indicators. And remember, that's what statistics are. They're just indicators when you're trying to look at everything globally and get a read on it. And you have to look at multiple indicators to get a feel for what's happening. Now we're moving on to the sale price for the first time. And clearly, as this impacts buyers, it gives them an idea of where they can afford to buy. Some of the affordable areas that people don't necessarily always think about are Redwood City and the coastline over there by Half Moon Bay and those kinds of things. But then Santa Clara County tends to be cheaper than San Mateo County, and it just gives you a little bit of a range. The middle number is the median price. The number to the left is the lowest 10 percentile, and the number to the right is the upper 90 percentile, the top 10. So basically 80% of the homes are between the two numbers, and 40 are between either the middle number and either outside number. This is showing appreciation from the entire calendar year 2020. So instead of letting my base year value fluctuate, I took the entire 2020 calendar year, got the median price, and looked at value. And there's a couple areas that hit their record back here off the chart, and before July, back in June timeframe is when they hit the record. But some of these areas are still hitting the records, but like the moderate low and the moderate priced areas in Santa Clara County, they've come down. I should flag, maybe keep the record over here so we can know. But I think we were up about 25%, and you're down to 22% now. So it's not down dramatically, but some of the changes are pretty significant. I mean, in South County, they were at 25% above 2020's pricing, and now they're only 9% above. The Valley overall, Santa Clara County is at 17% now. And you can see here, basically the first week of July, it was at 24. So it's come down 7%. So that almost doesn't make sense when the market's superheated and yet the values are coming down a little bit. And it's not necessarily the property values, it's just a matter of what's happening to sell. But when it's across the board like this, it does tend to indicate the properties are coming down. So basically, the only thing that makes any sense is the premium buyers were willing to pay earlier this year is a smaller premium now to get out of the hunt of buying a house. And that may be simply they're feeling a little bit less pressure, even though they're still overbidding a significant percentage of the time. So I threw up this chart earlier. So now what you're looking at is today's data, which is through midnight last night. You're looking at DUI, and the redder the color, the hotter the marketplace is. And so, someone's looking at the moderate areas in Santa Clara County, which is Santa Clara, Campbell, Cambrian, Willow Glen, for an example. You can see they're a pretty deep red. DUI is at 13. That is a pretty amazing number. And again, the lower the number, the hotter the marketplace is. Then you look at frequency of overbidding in that same micro market. 82.5% of the sellers are getting more than their asking price. Of those 82% that are paying more than the asking price, they're paying 8.3% above asking price overall. But yet, the reason it's blue here is that's price, nothing to do with market conditions. The median price is 1.64. The cheapest 10 percentile property is 1.26, and then most expensive is 2.8. So you can look and see what kind of market conditions you're experiencing in each of the different areas. And it's just one table that basically summarizes both counties, both types of properties. And what I will point out is on condos and townhouses, instead of doing red being above the median and blue being below, there's so few areas, I just did the median being white at 1.3 million, which somewhat corresponds to white in single family homes at 1.7, but then the cheaper areas got darker blue. So I only went one direction in colors. And you can see that most of them are pretty close together. And it is a little bit hard to tell, these two, 890,000 and 930,000, they're pretty close together. But even this 1 million, and I'm going to check my data because I was having a little problem on it, it looks pretty close. It is a little bit fainter blue, but it looks pretty close to this up here. So, I guess $70,000 isn't that much in my shading, but then you can see the 71 is a pretty much darker blue and the 71 is a darker blue. So that was that concept. And this is a little hard to explain, but I'm looking at October data and I don't get October data until November 5th. So how in the heck am I doing that? Well, all the historical data is starting on the 1st of October and going for 35 days. Since we're not there yet to get October 9th data, I went through midnight last night on the 8th and went back in time 35 days. So the concept is like next week, this is going to start becoming relatively interesting to compare where we are at this time of the year to the last 20 years. Right now, we're not really in the same league because most of the data is not there. This next chart is very similar. The layout's the same, but now I'm looking at September data. So this is data as of October 5th, and October 5th is behind. And so now just a few days ago, basically, since, we're only October 9th, so 4 days ago, you can compare. So this is where for this week, it makes more sense. Where do you stand? So we stand at 676 inventory. That's the record low. You can see we did come in below the 700 that was the value in 2017. Your days of unsold inventory is at 20. That is below the 2017 year. Your median price, and I'll point that up back up here on active listings, and this almost seems bizarre. We're talking about how hot this marketplace is, but yet the median price has come down in the last year by not a lot of money, $35,000, but now come down and look at what's actually selling. It's up by $200,000. So that's showing the shift in the micro market and stuff. And what's interesting is years ago, I had a consumer that basically saw this 1750 and this 14.8 and said, sellers are taking a $350,000 haircut on average. I said, no. The homes up here are it's apples and oranges comparison. For example, if the high end of the marketplace is slow, the high end homes are going to stay on the marketplace for a longer period of time, therefore making up a greater percentage of your inventory and therefore raising your median price of what's on the marketplace. It's a valid data point, but you have to be real careful on what conclusions you draw from it. So sales per day, 33.7. It's down from last year. Why is that? I think we're limited by supply. There's been a lot of talk for a lot of years about we've been limited by supply. And I kept saying, no, we're not, when we were at 25 and 30 days of unsold inventory. We didn't have to have increased supply of inventory to have an increased sales. We could increase sales with less inventory, which means you weren't constrained. Now, pretty much every time we get an influx of inventory, we automatically have the following week an increased sales jive. So demand. So I think we're finally at somewhere around 20, maybe 15, you start to be supply driven on the volume of transactions. So this drop from 34.7 last year to 33.7 this year doesn't concern me. I think it's because we don't have enough units to sell. And then down here, I talk a little bit about what the median square footage is and the average bedrooms and bathroom counts. And then you jump down to closings. So you have sale price and you have the overbid at 107%, significantly above the 106% that we had in 2017, 70% of overbidding in 17 versus 80% now. So you can see you're up, your median price is up dramatically from last year and your level of closings is up. So we actually closed more transactions this year than last year, even though the number of offers going in now is less than it was last year. And with that, I'm done. I bring up this slide again and I'll pause and see if anyone's got any questions questions for me. And if nobody's got a question for me, I will see everybody next week. Not seeing anyone with questions. Have a good week, everybody. Take care.